T here with my friend and co-host Zach Miner. And today, as usual, we're going to tackle the most pressing questions the market and economy has to offer. I'm going to start by talking a little bit about how the economy looks. It's been pretty strong lately, right, Zach? Talk a little bit about the markets where we are, and then talk about three optimistic reasons why I think things can press higher throughout the rest of the year. Zach, what are you talking about today?
I love it, man. I love optimism. I just want to hear it fired up.
Okay, great. Let me start then. Slide number one here. Hey, last week was an important week for the markets and the economy. We've got the January jobs number. It was much higher than economists anticipated. Over 350,000 jobs created. I think it was over 200,000. Was that right? About 200,000 more than economists had estimated. And the Federal Reserve said, Federal Reserve Chair Jay Powell, Jay Powell, said, you hardly ever hear something as concise, simple to understand from a Fed chairperson. And Jerome Powell's been the Fed chair for over 5 years now, appointed by then President Donald Trump. He said, and I quote, "This is a good situation. Let's be honest. This is a good economy," which on the face seems very good. Of course, markets reacted negatively because that would suggest that interest rates, there's a pending cut coming on Federal Reserve interest rates. The market had expected a 50% chance of a cut in March, the March meeting next month, and now it's down to like 15% or something. So he had really stamped out some of the optimism there on rates decreasing. Of course, lower rates would stimulate the economy and perhaps the stock market as well. But be that as it may, things are strong. Things look great. The inflation numbers are going down. So one more fact, and then Zach, I'd love your feedback here. Inflation numbers have come down. The Federal Reserve is expected to normalize interest rates, and I'll come back to that in a second, because inflation has come down. I think the last element of inflation that had remained high was housing costs. So right now I'm looking at a chart, and we're seeing here the year-over-year increase in the national rent index going back to 2019. And you can see that it was well above double digits, 15 to 20% during COVID. People were cashed up from the government stimulus. But now you can see over the last, what's it look like to you, Zach, 6 months, it's been negative. In other words, year over year for the last 6 months, we're seeing rates of increase for rental and housing costs decrease, become a drag on inflation. So that's been a lagging element of the CPI. And I think it's going to be a reason inflation could possibly get below 2% in the coming months. What do you think, Zach?
Yeah, and I actually have another chart similar to this one, that's also adding in wage growth alongside it later on. But I do want to add a couple caveats to that jobs number, because look, headline was fantastic. It was up over, you're right, 200,000 over expectations. They also revised higher prior months for December or for November, December. But there were some underlying numbers within the jobs report that weren't quite as rosy. And the first one was that hours per week dropped from 34.6 to 34.1. And that's the lowest average weekly hours since March of 2020 at the onset of COVID. So yes, there's more jobs being created in the economy, but perhaps folks aren't working as much within those jobs. So that could mean there's more part-time positions, more temp positions, things of that nature that don't necessarily make for a strong labor market. And then there's one other thing, is that there has been something that has happened similarly to prior recessions, where the household survey measure of employment hasn't been rising nearly as fast as the payroll. So there's just a bit of a disconnect between these two numbers. Non-farm payrolls were up 244,000 per month over the past year, but that household survey is up only 101,000 per month. And that's just a large gap between those two numbers. Which was a bit of an oddity, but it's something that has happened similarly before prior recessions. So,
this is a great time. Our favorite quote, my favorite quote, Zach, your favorite quote, the market is, and this is Benjamin Disraeli, there's lies, damn lies, and statistics, right? And dang, you go down a couple layers here in the onion, it gets pretty hairy pretty quickly. Be that as it may, I think there's some reasons here for optimism. We'll see maybe some seasonality in that January payroll. We talked just a couple podcasts ago about how the household survey had been changed significantly because people just don't pick up their phones anymore to take the survey from the government to tell them how they're feeling. Right? When was the last time you picked up a number on your phone you didn't recognize? So I
Yeah.
think those are all contributing factors here as we think about
Yeah. And one
about the numbers.
and one possible explanation just for why some of these numbers are the way they are. We've had some really big government spending. We've had the CHIPS Act, the Infrastructure Bill, the Inflation Reduction Act. These three big bills that were designed to, create kind of temporary lifts in certain sectors of the economy and in certain areas of the employment market. So you kind of have to take it with a bit of a grain, of salt to say that, hey, some of this could be temporary, and
Well,
absent those government factors, it might not look as fantastic as it does on the surface.
wasn't there a great Reagan quote like "There's nothing as permanent as a temporary government program" or something along those lines?
That's
It's
true.
just,
That's true. And I do agree with that to an extent, but these are very specific things with defined,
mm,
defined levels of spending, right? It's just like the CHIPS Act is kind of one package. It's not
great point.
necessarily an ongoing, program that has been implemented. But that is a good point, because you just look at the level of deficit spending and the level of government spending, and there's really
It's a concern.
it's a concern, but neither party is really talking about it anymore, at least at the top, right? I mean, either Biden or Trump. I think most people are expecting spending to stay relatively close to where it is.
Listen,
Um,
we'll talk about this
yeah,
in coming podcasts. Deficit spending, it's the elephant in the room. Like any good, administrator or manager, we're going to sandwich the negative news in between good pieces of good news, right? So we start the economy strong. The deficit is terrible. It's getting worse, and no one cares.
right.
We'll have to pay that piper at some point,
And that
and we'll talk
distorts
about it.
it distorts a lot of these numbers, a lot of these things that we
Absolutely.
look at.
So we'll continue to focus on that as the time comes. It doesn't seem like it's a pressing concern at the moment. But hey, listen, at some point in the midterm, long term, it's something that must be dealt with. So back to the good news, because this is trying to regain some of the optimism here, and things are optimistic. I want to turn to the market. So the next several slides that I'm going to be sharing with you right now are three reasons why I think things could grind higher into the entire year. And one thing I want to point out here is that I have started to see, and you've probably seen this too, Zach, some discrepancy in the headlines. From you go to CNBC or the Wall Street Journal, there are a lot of headlines right now talking about how there's a pending correction coming, right? And that makes me always feel better, because I like it when there's dispersion in the
Right.
commentary. I don't like it when everyone's on one side of the ship. So I think that could mean there's still some money on the sideline. The first point I want to make to you is something called the January effect. We talked about the Santa Claus rally last time. I want to talk about the January effect. So there have been 31 times in the last, I think this is the last since 1950, that the market was up 2% or more in January, and it was up 2% or more in January of this year. That's the S&P 500. International stocks were flat, up 84% of the time in the next 11 months, with a 13% median return. So I think that's pretty optimistic as we go into the new year. And I'm just going to go right into the next chart, with the caveat, this is the most complicated chart that I've put on the screen in the last several podcasts, but I think it's important. I want to draw our attention, because the big question, as we already alluded to, is what's going to happen with the Federal Reserve. When are they going to lower rates? So a couple of charts here just to talk about that specifically. So this is looking at the last 10 rate cycles. It goes back about 40 years. That's when the Federal Reserve starts cutting interest rates from a peak. Okay. And of the last 10 times, this goes out 1 month and 6 months and 12 months later. But if we're looking here at this particular chart of those last 10 times across all examples in the last 40 years, the markets were up 80% of the time when the Federal Reserve started lowering rates. And that's slightly higher than average annual returns. But the median is 11.4%. Now, I want to take a step back and identify that there are three basic outcomes here that this particular chart identifies. First is the market going back to like a normal, right? In other words, mission accomplished. We're going back to a normalization of interest rates. And that would certainly be the case for where we are now. Inflation seems to be tamped down. So we're looking to come back to a normal rate that doesn't hinder the economy. Okay. Then there's a panic cut, which is what it sounds. And then finally, there's a recessionary cut where the economy is in a recession, and we need to stimulate that economy and lower rates, right? So those are the three criteria, the three ways that, or environments where the markets would be reduced. And we're certainly in that first case. Now, there have been 4 of those previous 10 times in the last 44 years when there was a rate cut cycle. 4 of those times were in a normalization cut. And that's presumably what we're going to be coming into. And 100% of those 4 times, 4 for 4, the market was up 12 months later. So, oh gosh, I think that's a really optimistic situation here. There will be a return to normal. The Federal Reserve has insinuated that they will lower rates 75 basis points probably this year. Markets expecting a little more. It's coming to a normalization, which could be pretty conducive here for market returns in the next 12 months. Zach, any feedback on that?
Yeah, I think it's similar to a chart we looked at last week where just the outcomes are very dispersive based off of whether or not we are in a recession. And I think this kind of shows the same thing. It's interesting that the panics are the highest one because, panics are usually very drastic and very violent, but usually short lived, not necessarily a systemic type of thing. So I thought that's interesting that that's the highest one. But it makes sense that if you're in a recession, the cuts don't necessarily, mean that much in the initial 12 months. That's not an environment where you want to see the rate cuts, right?
Yeah, exactly.
You
So
want to see it in more of a normalization.
I think it could, it is cause to remain optimistic. We, long-term investors, I think in general win out. And I think we are looking for excuses to bolster that for you all at home to stay optimistic in the long term. There will be bumps on the road, of course, as you've already experienced, but we need to stay the course. And I think things look particularly good here coming into the next 12 months and especially through year end. So I'm just going to move on to my final 2 charts here. One of them is serious. One of them is not serious, but the next one here is, we are looking at rate cuts as we just discussed. And there have been, 20 occurrences since 1980 where the market has started, the Federal Reserve has started cutting interest rates when the stock market was within 2% of all-time highs, which is curious because we are near all-time highs at the moment. And there's been some conversation if the government or the Federal Reserve should cut rates at this time. Well, it's done so 20 times previously, and of those times, the market was higher 100% of the time 12 months later. So past is not prologue, but it's certainly a place that we can start investigating for some insight into what could happen going forward.
It's a
so that
solid
was
number of observations.
20. Yeah, I think I like the previous chart
Something.
had an observation. It was 4 for 4 is still impressive. 20 for 20, pretty good.
Yeah,
Pretty good.
not bad.
Cool.
Could also mean mean reversion.
We'll talk about that next time. All right, so going to another sample set here. And what am I looking at? This could be like about a 13 or 14 occurrences here. If you're looking for someone to root for here in the Super Bowl coming forward, if you're a big fan of Taylor Swift, like everybody is, of course, you're voting for the Chiefs. But that being said, this is an interesting chart here put out by Carson Economics, and it looks at instances where there was a blowout during the Super Bowl, and it typically tends to be, this is one of those meaningless statistics, but it shows you that when there's a blowout with a point difference of at least 20 points, typically a good thing for the stock market. So, with a median return of almost 15% and 85% of that year being positive. So, if you're voting for nothing less, vote for a blowout. Could be good for the market going forward.
This is what they call data mining.
Data mining, and I was like,
just mine it until you find something.
Meaningless noise here. You can, anyway, just something fun to end on here. I do remain optimistic. Zach, what do you have for us?
So I have something a little more drilled down. So as you may or may not know, Meta had a blowout. Meta, formerly Facebook, had a blowout earnings quarter this past week, and stock was up like 20% in one day, which corresponded to $196 billion single day market cap addition, which was
I didn't see this chart. This is very interesting.
The largest it's ever had. It is now one of the $1 trillion companies after this past week's price explosion. And just looking at this chart, that doesn't necessarily tell you that much if you don't really have some context. So on the next slide here is the total market cap of some other notable companies that you might be familiar with. Intel, Disney, Intuit,
So in
Comcast,
other
Wells
words,
Fargo,
on
Verizon.
Friday, Meta added an Intel in market cap.
More than
Wow.
more than an Intel and market cap in a single day, which just tells you the scale of these guys, man. The big tech names, just how big companies that they are. Um, you know, Verizon, Pfizer, Nike, not small companies, but uh, Meta adding that in a single day is just exceptional, and it really just tells you the scale of what these companies are accomplishing. And I have been seeing a decent amount of comparisons between where we're at today with what tech has been doing versus 2000, right, and the tech bubble. And I really think it's just completely different environments. The dot-com bubble, as it were, many of those companies, not all, but many of them, I would say most of them, had no earnings whatsoever, right? These were super
Unprofitable companies.
speculative, unprofitable companies that had no earnings or real revenue to show for it. If anything, with a .com at the end of their name, was soaring in valuations. Now, if you look from a pure valuation perspective, the Nasdaq relative to history is certainly overvalued, right? It's hard to argue otherwise. But these are fortress companies. These are massively cash flowing companies, billions and billions of dollars a quarter that these companies are generating in cash flow, profits, earnings. Facebook just declaring that they're going to pay their first ever, or Meta is paying their first ever dividend and buying back $50 billion of stock. So I think it's a very different environment. So if you look on a purely valuation perspective, yeah, things are stretched a little bit.
This is interesting.
Maybe
So
more than a little bit.
I'm down here in the trenches doing some data mining while you're talking, and I thought it was
Yeah.
interesting, a point to bring for folks at home, because you do see this. If you look at a historical chart here, and you can Google it, of historical price to earnings ratio, that's the measure of earnings per valuation of the stock, very common metric. And if you look back to the tech, the tech crisis, the dot-com bubble, you couldn't even measure it because there was no earnings, right? It's the price to earnings,
Right.
price divided by earnings. You can't divide by zero. So if you actually look at this chart, it's stratospheric. It's above 150 price to earnings ratio, and unmeasurable, because for it looks like a couple of years there was no earnings to divide by. So contrast that with today, and I'm just looking at some data here. The current price to earnings is about 25. That's actually below the 10-year average of 28. I'm pretty surprised by
For the
that.
S&P, right? The S&P
No, this is the Nasdaq. Nasdaq price to earnings right now
forward.
25.
I think forward. I think is 25. I think if you look on a trailing basis, closer in the 30s.
Mm-hmm.
But yeah, I mean, certainly,
Below average for on one metric.
yeah. But these companies have real earnings. I mean, these are just billions and billions of dollars a quarter of cash flow being generated. So I just
Totally
thought it was
different
interesting.
time, as you said. Yeah.
Yeah, totally different time, but man, 200 billion in a day. If you look at that list, Apple's on there 4 different times, had $150 billion plus days, 3 days in 2022, and that was coming off lows. So, I mean, that's not that amazing, but interesting. And so moving on, we talked a little bit about some of the good news, and this is Goldilocks. I mean, this is really what everyone was talking about in 2022, 2023 as like, hey, what could the Fed possibly do? What could this economy possibly do to really justify what was happening in the market? And this is literally it. It's 2 consecutive quarters where the core PCE, which is the Fed's favorite measure of inflation, running at an annualized 2.0% rate, while real GDP growth accelerates. I mean, that's it. You couldn't have put these numbers on this chart, a year or 2 years ago better than they are currently, and thinking what would be that perfect scenario.
Should we stick Jay Powell on the U.S. National team for Olympics, since he can stick the landing? I mean,
Stuck the land, yeah. So far, and look, there's always long and variable lags, right? We don't know what we don't necessarily know is brewing under the surface, but all signs right now point to that they actually did pull this thing off. And I think if we've talked about it in the past, looking at the inflation numbers and how shelter inflation is going to continue to decline, and we just know that that's a fact based off of the fact that it's lagged, and so they're going to get pretty close to that inflation target. Maybe not all the way down to 2 if some goods inflation reaccelerates a little bit, but they're going to be in the 2s for sure. Um, and real GDP is continuing to accelerate. So far so good. I mean, that's really the numbers that you wanted to see, and
I
has
can't believe the Federal
thus
Reserve
far.
Bank of St. Louis. Who is that? Yeah, St. Louis has a chart called the Goldilocks chart. I guess it's not called Goldilocks. That's your expression,
Yeah.
but it looks
No,
like
yeah,
that's what they're
no, they
measuring.
didn't. No, they did not. They did not call it
It'd be hilarious.
that. This next one goes. I think it's a little, maybe even uh, a better indication of that first chart that you showed. So the first chart you showed was just that red line, right? You were just looking at U.S. rents kind of growth rate. This is a cumulative index to January of 2020. But shows the same type of trend that, in the 2022, mid 2022, 2023 time period, double digit rent growth, year over year, really squeezing people. But all along the way, wages, average hourly earnings were chugging along and going up as well. Now that we have rent, declining, outright rent deflation, those two things have crossed. So if you look going back to the beginning of the pandemic to today, your average hourly earnings are worth more than what rents have gone up. And so housing should be feeling, and I know this is this is an average measure, right? So this is not everyone. I'm sure there's plenty of people out there that are really feeling squeezed on their housing, but across the economy, wages have outpaced. It took a roundabout way to get there, but it has over the past 3 years.
It's amazing. It means, yeah, housing becomes more affordable for the average person.
Yeah, yeah. Another good sign of the economy, and another good sign of strength that earnings have kept up even through these bouts of inflation. Certainly, I think it's interesting because you see these numbers and then you look at approval ratings of the president, which are usually very kind of closely tied to economics, and then also just surveys of how people are feeling about the economy, and people don't feel good. And I know we've talked about this before about when people think deflation or they think inflation coming down, or I'm sorry, when people think disinflation, they want to see deflation, right? They want to see prices come down, and unfortunately, that's just not really how it works. You also don't, you don't want to see that. That's not good for economies. But and I think that just feeds into these surveys where folks are saying, "Hey, the prices aren't coming down, right? They're still high, you know, even if they're going up at a slower rate." Um, so it's interesting to see, the data is the data, and then also compare that with some of the more kind of subjective sentiment and poll numbers and things like that show that people aren't feeling great about it.
Yeah.
So going to this next one, I think this really shows again, just in a different way, what you were talking about in that one table, just kind of an average performance after first cuts. And this is just looking kind of across. This is looking at the Dow, going back. When's that first one? Back to 1921. And just kind of shows just months prior to months post when you get that first cut, and I think typically the cuts don't happen in that recessionary environment. So I know yours only went back to what,
1980.
64 or 84, and how many were recessions? One, two, there were three. So three of those 10 we're in recessions, and that's typically where you get the negative performance. So it kind of stands to reason that outside of that, as you get those cuts, typically you have good performance, and they're telling us they're going to cut, right? Whether or not it's not going to happen in March, but right now I think the market's got a 70% chance of May. I think Powell is setting the table to do it in May as long as we get two more really good inflation reports, decent inflation reports. I think he's setting the table to do that first cut in May. So they're telling you they're going to do it. Looking back in history, what happens when they do it outside of recession? That's typically good for markets. So I think that's just pretty interesting to look at, and we're kind of following right along that. Really the last 3 or 4 months. kind of just treading a little bit here in the second half of the fourth quarter last year and the first half of the first quarter here.
I think the natural question is, how much, if any of this, has been already priced into the market? Of course, this rate cut is, amongst the most broadcast and
Right.
telegraphed breakcast of all time, at least in my memory. And it seems like, the markets have been waiting for that, and the markets kind of zig or zag depending on what the Federal Reserve Chair has said that day. What do you think?
That's such a good point. That's such a good point. And really, the speed at which information moves now, it's just not comparable to almost every instance on this list, right? Going back to 1921 and 1924, into the 30s and
Yeah.
40s and 50s, the speed at which information is disseminated, processed, and acted upon in the market is just completely different than what it used to be. So you're absolutely right that performance, that plus 15% after that first cut, could have certainly been pulled forward. That is a very good point and certainly possible. And if you look at it from kind of valuation perspectives, you would kind of say, yeah, it probably was. But that doesn't necessarily mean that momentum can't kind of take things further. I don't know if that's necessarily a good thing for 2025 and 2026, right? I mean, you could have a situation where we kind of pull forward too much. But that's a really good point for sure.
Well, we'll have to wait and see. Time will tell.
Yeah. And the final one, we've kind of looked at this for the last couple of years, really, that some of the fundamental indicators, especially this conference board leading economic indicators, which is a credit index, ISM, manufacturing, new orders, building permits, things like that go into this index that they consider to be a fairly good predictor of recessions. And every time going back for the last 60 years, when we have had this steep of a decline in this index, we've already been in a recession. Now, I don't think there's really any arguing that we're in a recession right now. I don't see anyone saying that. But it just does make you think that there's really been no other instance. You want to talk about, 100% hit rates. This is one where if we've had this significant decline in this index, it's been a recession. So I think that you always worry or, be wary of saying it's different this time. You don't necessarily ever want to say that. But I do really think that the unprecedented stimulus through COVID, the shutting down the economy, the drastic reacceleration, all the money that was put into the system, through stimulus, it really could have just distorted all of these things so much that it doesn't mean quite as much as it used to, or it would in somewhat normal environment. Which is really the only reason that it would make sense, because otherwise, these are real indicators in the economy that would indicate a slowdown.
It's a great place to end on. Listen, we shared a lot of optimistic points today, but listen, there's a lot of reasons to be, steady, if you will, not to be overly optimistic. And I think this is a great one, but I think it comes back to my previous question to you, Zach, is, and sorry to put you on the spot, but I feel like, was it 18 months ago that the yield curve inverted? Was that maybe like 16 or 18 months ago? Does that sound about right?
Yeah, about that.
And that's big news for you watching at home. In our world, when we're watching this, that's an indicator of a possible recession coming down the road. And doesn't have 100% hit rate over the last 70 plus years. And it was talked about as part of the reason why we talked about this earlier this year, that Bloomberg Economics predicted with a 100% chance of recession in 2023, which didn't materialize. And right. I wonder if, because the dissemination of information has increased to the point where everyone's aware of these relationships, that it's kind of distorting the future, right? So that's why we always have to say past isn't always prologue, because things are ever changing. And I wonder if that's time will tell, but I wonder if this leading indicator will be similar to that inversion in the yield curve, that indicator.
Yeah, it's possible, and we could come out of this. We could be doing one of these shows this time next year or 18 months from now, and looking back, and the yield curve had uninverted. By the time the Fed cuts the short-term rates, long-term rates kind of stay stable. The yield curve uninverts. this leading economic indicators reaccelerates, there already is a little bit of a button hook on the end of it. This is a month old. There was a little bit more of an increase in this last number for this. So we could be sitting there and saying, hey, this was the one that was different, right? This is the time where it didn't trigger.
It's certainly reason enough for you to tune in next year to find out that exciting,
yes.
that exciting. Hey, I'm excited to talk with you in a couple of weeks, Zach. Our next podcast is going to be what we're working towards calling foundations of finance here on Finance Footnotes. Just a chance for you to kind of pull back at the 30,000 foot level with some lessons that you can lean into in your investing life. So I'm excited to share that with you next time we get together. Anything else, Zach, before we sign off?
No, that's good, man. Looking forward to it.
No, sounds good. We'll take care, everybody at home, and we'll see you next time on Finance Footnotes.